Hello everyone and welcome back to these sessions on financial reporting. Friends, in this class of financial reporting, I am not going to talk about financial reporting. I am going to actually discuss with you integrated reporting. Now, what is integrated reporting? If I ask this to a student facing CA final examination, a student would say, sir, it is one small theory topic in our syllabus, which I don't understand why it is there in our syllabus. I tried to read it, nothing goes into my head. It's talking about some types of capital, this and that. But friends, let us face the reality. Let us reveal the truth. This is going to be the future of reporting. Believe me, this is going to be the future of reporting. I will not just say that as a fact and simply because it is written in books I am also uttering. There is a clear reason behind that. Try to understand the way the business environment has evolved. The reporting also has to be done accordingly. Just think of one thing, all this time what has happened in reporting. Just look at Indian scenario. We had the simpler version of accounting standards. Why did we bring Ind AS into application? There was a need for global financial reporting standards, harmonization of reporting, financial reporting across the world. That was one specific requirement that all the investors across the world, if they are investing anywhere, and when they look into the financial report of that entity, they should be finding the balance sheet, the profit and loss statement as readable and understandable. And when can this happen? When all the entities across the world, they are maintaining their or they are presenting their financial statements in the similar manner. That is where harmonization comes into picture and where we have global financial reporting standards. But in the year 2010 and little before that actually, there was a bigger thought process that what is being observed by investors today. Why would an investor invest in startup? If you think, if you go and ask an investor that, boss, what do you look into when you are investing in a startup? That investor would say, if I am investing X amount today, after some time I would want 2x amount, I would want 3x amount. That is what I am seeking. I want to enhance the value of money that I am investing, or simply I want to enhance the value. I want that value should be enhanced. Enhancement in value, or basically value creation, has become objective of the business today. Think of companies which are running into losses, but if you look into the market capitalization of these companies' share in the stock market, it is still increasing. In spite of incurring loss, they still have a big huge market capitalization. Someone who would have purchased this company's share some years back is now having good growth in the share price, even though the company is incurring losses. But if you ask a question why there is enhancement in value in spite of the fact that company is incurring losses, there is obvious reason for that. The company has expanded in terms of its market. It has created huge market dimensions. It has created huge customer base. It has a good manpower. There are lots of other values that are attributed and attached to that organization. Isn't that creating value? It is creating value. So friends, today if you look into, people say that let us once penetrate the market, and once we penetrate the market, then we will make profits. Penetration of market, creating your market share has become an objective today, more important than earning profit. So today if you look into new startups, they are not aiming at earning profit right from day one, because they know that they have to keep patience to the time that they step into profit making objective. Point is, they are having clear intent of making profit. I am not saying they are not for profit type of organizations. They are for profit organizations, but their primary focus is on creating value. Friends, just imagine when the business objective is focusing towards creating value, it is an obvious thing that reporting also has to accompany that, and that is where integrated reporting plays a dynamic role. Integrated reporting will bring into consideration all financial as well as non-financial components that help in creating value. So here we are focusing not just on the finance of the entity, just the financial reporting is not the objective. We have a bigger objective, how that organization will be sustaining in its position in the future. Over the time, how will the entity create value? Over the time, how will the entity fulfill its other objectives? Whether it will be in a position to expand, grow and provide benefits to the capital contributories or not? How will be its social status? How will be its reputation? All these factors are definitely going to be important factors for an investor to decide whether the investor should park his or her money in such an organization. If that is a finance company, it will have its entire analysis whether it is interested in investing into this business or not. So basically, if I bring down this concept to a very small narrow situation, today if you come to me and ask me to give you some money as finance, I would look into, boss, what would you do with that money? I am not just interested in how much money you give it back to me. I am interested more into what you are doing with that money. Are you able to create some value out of that money? If yes, if you are able to create value out of that money, then only there exists a possibility of you giving me back that money with some value addition. And therefore, investors today globally, their perspective has also evolved. They would want to look into not your past financial records, boss. That could be misleading. Just imagine, I show you past 3 years financial records, very nice financial position till the last financial year, but that was all the past history, based on which if you give me finance, think I may not have prospects to survive in future. When you are funding to my company, should you look into my past or should you look into my future prospects? What happens basically when you observe a financial report and based on that you provide loan to someone, it could be a misleading scenario. Just imagine that past was good, future may not be. So what happens over there, we generally make a presumption that the way the entity has performed in the past, in the same way it will carry out its future business. That is not the right approach of today's investor. Today's investors are smart investors. They would want to not focus on just the past, but also in the future. If you are able to create value in spite of past losses, we still have faith in you that you will make profits ahead. In that case, an investor might invest even in a loss-making company because incurring loss in the past was a past, future is bright. Different perspective. On the other side, a company which was performing fantastic in its past and now its future is little shaky. Who will invest into such company? I'll give you a simplest example. We had our own coaching centers at 3-4 places across Mumbai. What happened in this pandemic? We were forced to shut down all our centers because no students are going to ever come to these classes. Everyone has started adopting this kind of video based learning. Now if you look into, to shut down all those activities which we were carrying out, we have incurred financial losses. And if you look into, will someone finance this business think, will someone finance this business? I'm not talking about this revived video based classes. I'm talking about the classroom training. Nobody will now ever invest in this classroom business unless situations change completely, unless situation go back to that kind of norms or that kind of normals which were prevailing earlier. So friends, investors today are not just looking into past, they will look into past, present and future. Past and present can be revealed out of your financial records. But what about future? Future is not depicted by financial records. That means you need more information, right? You need prospects. You need the financial and non-financial objectives of an entity, and you need various other information. That set of various other information, when you club it together, it is nothing but an integrated reporting. The concept of integrated reporting initiated in South Africa, and by the year 2010 a council was formulated, IIRC, which was formed in 2010. It had a clear objective, just like we have GFRS, that is Global Financial Reporting Standards. That way we will have global integrated reporting standards as well. So friends, when this committee has been formed, worldwide they have started passing on recommendations. What is the position in India? In the year 2017, particularly February 2017, SEBI has called upon top 500 companies in India and suggested them to start implementing the integrated reporting requirement. So factually there is no structured framework of integrated reporting yet, but the IIRC has formulated a framework. They have defined the core objective of integrated reporting, and integrated reporting, if it is done within that framework, it is quite enough. So friends, in India the status is very clear. These top 500 companies have not been given a mandate to follow integrated reporting, but they have been recommended, they have been asked to comply with this integrated reporting on a voluntary basis. So that is the status in India, and that voluntary application also has started from the financial year 2017-2018. So friends, whatever we have discussed, let us first write some initial notes on that, and then we step into the bigger dimension of this chapter, where creation of value is going to be the focus point. So let us begin with the fundamental question: what is integrated reporting? Integrated reporting is a concept that has been created to better articulate the broader range of measures that contribute to long-term value and the role organizations play in society. Integrated reporting is enhancing the way organizations think, plan and report the story of their business. Central to this is the proposition that the value is increasingly shaped by factors additional to financial performance, such as reliance on the environment, social reputation, human capital skills and others. Let us move ahead and continue writing further. This value creation concept is the backbone of integrated reporting and is the direction for the future of corporate reporting. In addition to financial capital, integrated reporting examines 5 additional capitals that should guide an organization's decision making and long-term success towards its value creation in the broadest sense. Integrated reporting reflects how our company thinks and does business. This approach allows us to discuss material issues facing our business and communities and show how we create value for shareholders and for society as a whole. Let us move ahead and talk about the historical background of integrated reporting. So you may please write the heading as organizational structure or issuing authority. Integrated reporting, that is IR, is a concept first introduced in South Africa. Later on, this concept traveled to many countries like Germany, France, Spain, Brazil and UK, and integrated reporting was made along with their financial statements in one or the other manner. In 2010, the International Integrated Reporting Council, that is IIRC, was set up, which aims to create the globally accepted integrated reporting framework. Let us move ahead and continue talking about IIRC further. So you may write the International Integrated Reporting Council, that is IIRC, is a global coalition of regulators, investors, companies, standard setters, the accounting profession and NGOs. Together, this coalition shares the view that communication about value creation should be the next step in the evolution of corporate reporting. With this purpose, they issued International Integrated Reporting Framework. Let us move ahead and now talk about what is the scenario in India. So in India, SEBI, via its circular dated 6th February 2017, has advised top 500 companies to whom business responsibility report, that is BRR, have been mandated under regulation 34(2)(f) of SEBI listing obligations and disclosure requirements, that is SEBI LODR, to adopt integrated reporting on a voluntary basis from the financial year 2017-2018. The objective behind recommending voluntary adoption of integrated reporting is to improve disclosure standards. Let us move ahead and now talk about the pinpoint objective, that is purpose of integrated reporting. Now friends, talking about the purpose of integrated reporting, I would want you to first understand what is the core objective of a business in today's business environment. Why I am talking about today's business environment? Because if you look at the scenario some 30-40 years back, all the profit making companies, or basically companies that were meant for earning profits, they had simple objective of generating profits, that's all. Over past 30-40 years, if you look into the dimension of business, its objective has undergone a big evolution, I would say. Today, new startups, they definitely will have objective of profit making, but that could be their not number one objective. Number one objective today has become value creation, that is creation of value. So if you look into one thing, focusing on objective of the business, I told you it is creating the value. Let us take examples. Various entities that you have seen operating across the world today, when they started up, today's business scenario, people are starting up their business with a planned loss for a few years. Let us incur loss, no problem. We will gradually make the organization a profit making company, but initially the focus is on creating value. You take examples like Amazon. When Amazon started its operations in India, it has come up with such a strategy that it has suffered with a loss at the early stage, and until it has started generating profit, its core objective was just to create a brand value, just to create a new market share, just to expand its market dimension. You look into records of all the private sector life insurance company in India today, they are still making losses. Any reputed insurance company you talk about, they are running into losses. But if you look into one thing, if you look into their corporate valuation profile, the value is increasing gradually. So today, just think, if we start looking into little broader perspective, suppose you are shareholder of my company, I have asked you to contribute your capital to this company, and if the worth of this capital, if the value of this capital is increasing, even though on books, on records, the company is incurring loss, but if the value of this capital is enhancing, you are actually getting more and more value of the money that you have invested, right? So don't you think that there is a complete turnaround, there is a complete evolution that has happened in the core objectives of the business as a result? Because the business objective has undergone such a big change, it is implied that reporting also has to take that change, and that is where the purpose of integrated reporting comes into picture. Let me now talk about the purpose of integrated reporting. If you look into one thing, integrated reporting, if I have to define its purpose in one single line, it is to explain to the providers of capital. Providing explanation to whom? The providers of capital. What I have to explain to providers of capital? That how the organization will be capable of creating value. I don't have to explain how will I make profit, but I have to more clearly explain how the entity will create value. And here comes the focus on the value rather than on profit. I am continuously telling you one thing, that I am not saying that profit earning is not our objective, but creating value has become a more prior objective as compared to profit earnings. First of all, we are not focusing on not for profit type of organizations. So some charitable trusts which are not having an objective of generating profit, they may not be even required to present integrated reporting. We are definitely focusing only for organizations or entities whose objective includes earning of profit, which we call as for profit type of companies. So, but for them, more than earning profit, their first primary objective today is creating value. When you accumulate the stocks of different values, we would name them as capital. So integrated reporting is all about reporting your value. Reporting your value on year to year basis would reflect that on reported values, how your value has changed over the time. So a counterparty who is reading this integrated report will come to know that yes, this organization, it had so much of value previous year and its value is so much now. The value has enhanced or the value has changed. What is the cause of the change in the value? And a clear dimension on yes, this entity is growing, that growth will be observed. Even though the company is running into losses, you would find that the capitalized value or the market capitalization, if you even talk about the stock markets, the market capitalization would have still grown because various factors would play their roles. And therefore, when we talk about capital, we don't just restrict to financial capital. Here our understanding goes in the complete dimension, including financial as well as non-financial elements of capital. And that is where the next discussion that we have to make along with the purpose of integrated reporting is to understand the capitals. So the capitals, in this context, we are defining capitals as comprising of 6 different components. And the first component, the obvious component, is the financial capital. What you generally understand as capital from the viewpoint of financial reporting, it is the financial capital. The capital that you are raising by way of contribution of equity, raising borrowings, etc. That kind of capital employed in the business is what we call as simply financial capital. So you very well understand what is financial capital. I don't have to explain you what is financial capital. But the stronger the capital is, the more is the value of any organization. The next component that we have to understand is the first component of this other than financial capital, and that is manufactured capital. Please focus on the words manufactured capital. This is basically group of assets used by an organization for production of goods or provision of services. In other words, to produce goods and services, what kind of assets the entity is using, those assets could be natural resources, those assets could be manufactured products. That means it could be an asset for the entity, but it could be a manufactured product for someone. For example, if I am purchasing a car for my use, the car for me is an asset, but for that automobile company that has sold car to me, it was a manufactured goods for it. So when I say manufactured capital, I am talking about all the tangible assets which are used in my business. That means basically I am talking about property, plant and equipment. So various types of assets used in the business for the production of goods and services, which are not natural resources but manufactured capital. That manufactured assets is what we call as manufactured capital. Human capital. See boss, the value of an organization also depends upon its employees. Human capital means basically the human resource of the organization. So you could see that every organization will have its own separate culture. How an entity takes its human resource forward. In this scenario of lockdown, in the difficult times, there have been certain organizations which have explained to their employees that, see boss, this is a problem that we are facing, together we will fight it out. As of now, we will have no deduction in your pay, but we are expecting a complete dedication from your side to stand in support to minimize our losses as much as possible. We may not provide you bonuses this year, we may not provide you the variable component of your pay this year, but we will still ensure that no deduction is made out of your pay. On the other side, I have seen instances of organizations which have literally removed employees within a month. By giving a month's notice, they have removed the employees. That boss, we are into troubles, we cannot survive ourselves, how can we pay salaries to you, please leave the job. Friends, this is simply an organizational culture. Many organizations, they have made a pay cut for their employees. Now it may be a small or big organization, but big thing is the organizational culture. So friends, when it is a relationship of an entity with its human resource, how powerful the organizational culture is and how good its human resource is all coming under the head human capital. You would see there are many big companies which are spending huge amount every year for the promotion and development of their own employees, for their human capital. Why? Because they know one thing, that human resource is the base resource through which we will be able to survive, stand and earn profits, and most importantly create that value which is now becoming our primary objective. Human resource of an organization could be completely a big resource which cannot be ignored. Now what happens? We don't show human resource in our balance sheet. There have been instances of making valuation of human resource, but if you look into your financial reporting, your human resource cannot be identified as an asset in your balance sheet. But when it comes to integrated reporting, the value of your human resource should be assessed. That is where your organization's power in terms of its own human capital will be considered. Friends, I would say there may be entities where the employees are so loyal to the entity that no matter what happens, they will not let the organization fail. On the other side, there may be tendency of employees of behaving this way: boss, I am getting my salary, what happens to organization, I am least concerned. If this organization kicks me off, I will somewhere find another job. This could be an individual's tendency, this could be tendency of the entire employee force or workforce if the organizational culture is like that. So friends, you would see that if you have spent some substantial amount on the training of your human resources, and if this human resource do not sustain with your organization, then you are losing out your human capital. Human capital carries a big value, and that is why it is one of the important component of integrated reporting. Next point is a tremendously interesting point, that is social and relationship capital. Now friends, I have seen students not getting clarity with this point. I have seen teachers who have not been able to explain what is this social and relationship capital. I have read books, I have read the content on internet. I would say it is such a beautiful concept which literally no one has taken right effort to convey it to students in the rightful manner. Let me give a try over here to make you understand what could be a social and relationship capital. Let us bring down the size of the organization to a small partnership firm. Suppose there are 3 partners, A, B and C. Now the 3 partners among themselves, what kind of relationship do they share? Now friends, please understand this conceptually, because if this core concept is clear, you will get to know where I am leading to. So 3 partners A, B, C, one scenario, they don't have the right understanding among themselves. Their relationship capital is weak. They will not be coming to right terms in the rightful manner, and that is where their internal relationship creates a trouble. It doesn't create a value, it creates trouble. So friends, where we are having objective of creating value, 3 partners having misunderstanding among themselves will not create value. I am repeatedly telling you, they will create troubles, and somewhere everyone, each partner over there will not be happy carrying out the business activity in that firm. Think the other way. 3 partners in a firm A, B, C, they are having excellent understanding amongst themselves. It could be a big resource to the organization, right? Because if they are aligned with their thought process, if they are understanding, if they are open to accept each other's views, they will have a better value to be given to the organization. Let us now step 1 point ahead. Relationship capital does not restrict to that group of 3 partners. Each partner will individually have their own relationships. If each partner individually have their own relationship, suppose one partner is having very good terms with a bank manager, possible, right? So the moment there comes any investment opportunity or seeking some kind of loan, this one partner having good terms with a bank manager can do the needful. So availability of such a partner with this kind of equation with a bank manager, isn't it a valuable resource to the organization? Yes, it is. Suppose yet another partner who has a fantastic connection with transport business, and this firm is also into transport business. So the one partner which has or who has tremendous relationship in the transportation industry, right from the transport business owners to the local drivers and helpers, if they are very closely connected with this one particular partner, having that partner in your firm, isn't it a big value? You may not pin down that value on the paper or in your balance sheet, but still it is a value, it is creating some kind of value. Now, let me take you one further step ahead. See friends, I started with a small partnership firm and gradually I am expanding the dimension of relationship. Now you would have seen this whole society. Suppose you are my student, okay, you are my student. So you know me personally, I know you personally. The day you qualify, you come and tell me, sir, you have so many contacts. Lot of your friends today are CFOs and CEOs in organizations. We have this profile. Please tell these people to provide us some job opportunities. It's a good proposition, right? And these friends of mine who are CEOs and CFOs in different organizations, they need good human capital. Understand the equation. I have a fantastic relationship with them. I also share a fantastic relationship with you who are my students. If I have found you having a sincere approach to your studies, you will definitely have sincere approach towards your work. What is your attitude for taking the work in hand and accomplishing the objective? If I give you a task and you do it in a right spirit, means you are showing a composed mindset of handling tasks what comes to you. This could be indicator of high level efficiency. I would tell one of my friends who is CEO in an organization, in a reputed organization, that see boss, I have identified that from the current batch, I have a student whom I have identified that he has a bright future. I find tremendous potential in this person. You may just take his interview. Now what happens? A student used my relationship for his or her own job position. My friend used my relationship to get a very good human capital. This is all about social relationship. It creates tremendous value. Now friends, see, people talk about network, correct? That you should know, you should have a good social network. You would have seen today the social networking. I'm not talking about just Facebook or Instagram. I'm talking about portals like LinkedIn. If you could see, you have LinkedIn where all the business networks are found. So you would find someone's connection, and through you finally find someone whom you are seeking. Point is what? The wider the network you have, the better is your social capital. So friends, in terms of an organization, a big organization, let us now expand the complete dimension of this. If you talk about an organization will not have 3 partners. It will have huge number of stakeholders, but there will be some key stakeholders. For example, Mr. Mukesh Ambani is a key stakeholder in Reliance Industries. There would be other key stakeholders as well. How is the relationship among these key stakeholders is component of social and relationship capital. Now these people, if they have their own networks, you know what will happen? Combination of these big networks together will create a big value. Many a times you would have seen people talking about, you know, that you have a very good network, please help us in achieving this, and you find that the task is done just by a recommendation. So what is happening? Right links are created. I gave you example of you being my student, I am your teacher, I know people who can provide you employment. If this link is created, it is win-win situation for all. You as a student who just got qualified, you get a job, a good job. My friend who happens to be an employer gets a good human capital, gets a good employee. I get thanks from both the parties with which I am happy. Point is what? This is what we call as social and relationship capital. So friends, this is a beautiful concept. Unfortunately, in your study material, this has been explained just in a small paragraph. I will also give you a small paragraph in writing about this, but I will be putting a little additional effort and I will separately make a video on this whole topic, and more emphasis will be given on this social and relationship capital, and just wait for the right time. But what I am doing right now is something that is needful for your examination. So let me restrict myself not to go beyond this much, because the whole chapter in your exam would be for around 4-5 marks question. One question of 4-5 marks, that too uncertain whether such question will come or not. But this topic, as I told you in the early part, this could be a big evolution. Once integrated reporting becomes mandatory, people having knowledge about integrated reporting You just see what happens, because then integrated reporting will become one of your primary reports, and this importance I have explained you at the early part of the chapter. Let us move ahead. We have talked too much about these past two components of capital. Intellectual capital, it's very simple. This is basically, if you could see in the manufactured capital, we have talked about property, plant and equipments as assets. When we talk about intellectual capital, it is basically intangible assets which are used in production and supply of goods and services. Intangible assets which are considered as intellectual property of the organization. It could be in the form of patents, copyrights, it could be in the form of some kind of rights and licenses. These are basically intellectual assets, and they are technically called as intellectual capital. And friends, last point over here, which is again a very, very important point, natural capital. Now friends, just imagine two equal size organizations which are into maybe agricultural production. One is located in a place where balanced rainfall is observed every year. Another organization has its field located where rainfall is typically a problem. Just imagine what will happen if these both organizations are into agricultural production. What will happen? The one that has stability of rainfall will always be benefited. That additional value is coming from the natural resource, right? You are having stable rainfalls every year. That could be a boon to that organization which is into agricultural production. As a result, that is the nature which is giving you support to survive and grow. It is the nature that is adding value. That kind of capital we call as natural capital. So friends, location of the business and its access to natural resources plays a substantial role, and that is where the natural capital comes into picture. So friends, we have talked a lot about all these concepts. Let us now step by step write down notes on the same. So under the heading purpose of integrated reporting, please write: the primary purpose of an integrated report is to explain to providers of financial capital how an organization creates value over time. An integrated report benefits all stakeholders interested in an organization's ability to create value over time, including employees, customers, suppliers, business partners, local communities, legislators, regulators, and policymakers. Let us move ahead and write a note on value creation, and under this heading please write: value created by an organization over time manifests itself in increases, decreases, or transformations of capitals caused by the organization's business activities and outputs. The value has two interrelated aspects, that is value created for the organization itself, which enables financial returns to the providers of financial capital, and the value created for others, that is stakeholders and society at large. Now we are talking about targets, as in this concept of integrated reporting. Is it targeting every enterprise? The answer is no. It targets mainly the private sector or profit making companies. This framework is written primarily in the context of private sector for profit companies of any size, but it can also be applied, adopted as necessary by public sector and not for profit organizations. So fundamentally what we are trying to say is the public sector and non-profit making organizations are not having as such any need to go for integrated reporting unless they choose to do so. Let us step into the most important part for you to write down, and that is about the capitals. Now this is the core of the chapter, right? The capitals are stocks of value that are increased, decreased, or transformed through the activities and outputs of the organization. The framework has categorized the capital into 6 main forms. One is financial capital, of course, and the other 5 are manufactured capital, human capital, social and relationship capital, intellectual capital and natural capital. So we have talked about each one of these components. Let us move ahead and write in details about the financial capital first of all. The pool of funds available to an organization for use in production of goods or provision of services obtained through financing such as debt, equity or grants, or generated through operations or investments. The second one is the manufactured capital. Manufactured physical objects, that is assets, that are available to an organization for use in the production of goods or the provision of services, including building, equipment, infrastructure such as roads, ports, bridges and waste and water treatment plants. Let us move ahead and write a note about the third capital, that is human capital. People's competencies, capabilities and experience and their motivations to innovate, including their alignment with and support for an organization's governance framework, risk management approach and ethical values. Ability to understand, develop and implement an organization's strategy. Loyalties and motivations for improving processes, goods and services, including their ability to lead, manage and collaborate. Let us move ahead and write about the next capital type, that is social and relationship capital. The institutions and relationships within and between communities, groups of stakeholders and other networks, and the ability to share information to enhance individual and collective well-being. Social and relationship capital includes shared norms and common values and behaviors, key stakeholders relationships, reputation that an organization has developed. Let us move ahead and write a note about the other two capitals, starting with intellectual capital. Organizational knowledge based intangibles, including intellectual property, for example patents, copyrights, software rights and licenses. And then natural capital, all renewable and non-renewable environmental resources and processes that provide goods or services that support the past, current or future prosperity of an organization. It includes air, water, land, minerals and forests, biodiversity and ecosystem health. Let us move ahead and discuss something that we have not talked about earlier. Guiding principles for preparation and presentation of integrated report. This is the part that I haven't explained you yet, but this note first you write down. One of the distinguishing features of integrated reporting is that in contrast to compliance based reporting, there can be no model report. What does this paragraph convey? That there is no formal structure of making an integrated report. There is no formalization or some kind of fixed format or model set for integrated reporting. This is definitely not a compliance based reporting and therefore there is no specific format or model available. Every report must be built around the unique business model for preparer. This requires a very different mindset when looking at examples of good reporting. The starting point for understanding how integrated reporting works is considering the application of the content elements and guiding principles of IIRC's integrated reporting framework. So basically what this set of paragraphs is trying to convey, that you just have to mainly look into the integrated reporting framework that is set up by IIRC, nothing else. So the manner of reporting, the presentation of this integrated report could be done in the way the organization considers appropriate. What is the key point? That is, let this report stay around the framework which is the integrated reporting framework set by IIRC. Let us move ahead and write something more about this. The following guiding principles are considered in the preparation and presentation of an integrated report: strategic focus and future orientation, connectivity of information, stakeholder relationships, materiality, conciseness, reliability and completeness, consistency and comparability.